Our base scenario is that we're going to see a slight slowing in the global economy. In general, we're seeing many of the developed nations moving into a sort of a cyclical downturn. The only real concern in terms of global growth happens to do with the U.S.-China trade policy, and we think that the one thing that could derail growth significantly would be all-out trade war. The U.S. will continue to see deceleration. And the reason is because it's hit a cyclical peak, and we're going to start to slow down from where we are going right now. The effects of Trump's fiscal policy or fiscal stimulus, the effects of investment being pulled in because of fear of tariffs, so ramping up inventory, pushing forward manufacturing will all come down, and that will also sort of spill over into consumer confidence. We don't, again, see a significant deceleration in U.S. growth, but it's going to be noticeable. On the other hand, in China, we also see a slight slowing, but more to the fact that exports are dropping because of the uncertainty in trade tensions. And it will be very interesting to see how quickly the Central Bank of China is able to put together looser policy to help support falling demand. How we see the European economy shaping up, it depends a lot about what happens in Brexit. We're thinking more of a hard Brexit is the most likely scenario at this point, despite that the market is not sharing our same conviction. If there is a soft Brexit, which is more likely in the market's mind, we expect growth to sort of also fall slightly in the European region from where it is right now. How is Southeast Asia going to withstand the trade tensions in the longer term? And there's two sort of guiding principles or thoughts. One is that we'll see a significant deceleration as Southeast Asia gets caught up in that U.S. and China conflict. And what I mean by that is since Southeast Asia is sort of the supplier and a critical part of the global value chain, that as demand falls for the products in China, then we'll see a demand for Southeast Asian inputs fall as well. The other hand is that potentially U.S. President Trump's administration is really focused just on China. And if that's the case, we could see a migration of companies from China into Southeast Asia. And that would provide a significant uplift in GDP growth. Well, Thailand is really caught in the crosshairs. I mean, at one hand, it's a great manufacturing center for Chinese goods, automotives, which we know is being targeted by Trump in Europe. So on that side, it could be significantly dragged lower. On the other hand, it could be one of the key places that people relocate or corporates relocate in order to circumvent a lot of these trade tariffs that Trump is putting together. If we say that things sort of move along as we are now, we don't see an increase in trade tensions, we don't see an escalation, we see Thailand in a relatively firm spot. The number one key concern is trade tensions, not only because what the damaging effect it could have on the global economy, but how random and how uncertain each day is. You know, every day seems like it's a new tweet from Donald Trump. Every day it's a new reactionary tariff by the Chinese. This constant escalation and uncertainty is a real problem for global investors. I think equities are going to have a very challenging year. Number one, the valuations and the 12-month earning forecasts are quite high, and it's going to be very difficult for a lot of these companies to reach those revenue forecasts, those earnings forecasts, and keeping that type of revenue growth moving forward, especially in a higher interest rate, lower demand environment, is going to be quite difficult. So we think it's going to be a very challenging year for global equity markets.